Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, June 16th, 2018. And in today's video, I want to do a review of the 2018 issue of In Gold We Trust. And the subtitle of the In Gold We Trust report is Gold and the Turning of the Monetary Tides. So just as some reference and foundation here, In Gold We Trust is put out by a fund management team based in Liechtenstein called Incrementum, and they've been doing this report in Gold We Trust for the last 12 to 13 years. I look forward to reading this report every year. This year's report is really huge. It's probably over 250 pages or slides, has all kinds of graphs, information, commentary, historical narrative, and prior figures, and it's just a wealth of information, and I really look forward to going over this with you guys. I think in our current monetary environment, in the current economic environment, gold is being ignored. Everybody is living in the clouds, and this is, unfortunately, if we are contrary thinking, is typically an indication that we may be at a turning point. So I think it's relevant to go over this report. I'm not going to go over the whole thing, obviously. I'm just going to pull out some tidbits. I will put a link to the report and the condensed version of the report in the show notes, and I encourage you to take a look at it at your leisure. It is extremely informative. So I'm going to get into a couple of things first to set the stage. Our first slide, you can see here, this is a chart that shows the cumulative central bank printing binge that's been going on for the last 10 to 12 years. And as you can see, it shows the Fed, Bank of England, ECB, Bank of Japan, and the total amount of central bank assets, if you will. So central bank assets mostly consisting of sovereign debt that the central banks have been purchasing from their respective governments. And I have maintained, and I continue to maintain, that the current economic success or good times that we're having is a direct result of basically these central banks printing trillions and trillions and trillions of currency units. I think this chart really is self-explanatory. There's a direct correlation between the rise in the stock market, the bubble in bonds, just the bubble in everything that can be directly traced back to this binge of money printing that's went on by central banks. However, I still have various people that I run into on Twitter or email me that will not accept this. They just say this is not an issue. It's not a big deal. I reject that wholeheartedly. I believe that everything that we're seeing that's been going up is a direct result of the levitation provided by this central bank printing. And we've seen it. It's been called the everything bubble. You know, we have stock market valuations at historic highs, bond yields that were until recently at 5,000-year lows. I mean, at one point we had, I think, 40 to 50% of sovereign debt in the world trading at negative yields. That means people were paying the central banks to buy their bonds. And this was a direct result of the central banks going into the market and distorting the market by buying the sovereign debt and enabling, the physical irresponsibility of these governments. We have ongoing housing bubbles in Australia, various cities in Canada like Vancouver, Toronto. Same thing we're seeing in various cities in the U.S. now, especially on the West Coast, San Francisco, even where I live in South Texas in the Rio Grande Valley. When I first moved down there, let's say in 2000, I think it was 12, I live in a fairly well-off community, and houses would go on the market and stay on the market for 8 to 12 months before they sell. now as I do my daily exercise and walk around the community, I see houses coming up for sale and selling within, a week to 10 days. And this is in a very, not very wealthy community or area of the United States. Like I said, the Rio Grande Valley, about 35% poverty rate. I live in a well-off area, but I'm thinking, where are these people getting this money to sell these houses? And the house values are selling at higher values. So I think this is a direct result of just money printing and seeping in and infecting every nook and cranny of the economy. We've seen record prices for art recently. We've seen paintings sell at $500 million. And of course, the Bitcoin and cryptocurrency bubble that's in the process of popping. This is a direct result of, same thing, money printing. We have personal, corporate, and sovereign debt is soaring and is at all-time highs in some cases. We have $1.5 trillion in student loan debt out there for a bunch of degrees in basket weaving and women's studies, which will get you a job as a barista at Starbucks. Corporate debt is soaring. We've seen a lot of defaults now, the recent default of Toys R Us. I am looking at, this is kind of a side note, but I am looking at corporate debt as a major short opportunity coming up. My thesis is that the Federal Reserve is going to continue to raise rates until they break something. I don't know what they're going to break, but I do know that when this corporate debt cycle, or this debt cycle that we're in, pops, there's going to be a tremendous amount of reckoning and bankruptcies and restructurings in the corporate debt market that will present a tremendous opportunity, not only at the top, on the way down, and at the bottom, when we will be able to step in and buy washed out corporate debt. I would, based on past cycles, some issues will be able to buy at 20 to 30% yields to maturity. But that's down the line. So we have everything going up except for one thing, commodities. And we have a chart on that later, and I think that you'll find that interesting. So the conclusion of the In Gold report, in Gold We Trust report for 2018, is that gold is in the early stages of a bull market. And what I'm showing here is a U.S. dollar cycle since 1973. You can see the cyclical nature of the dollar making highs and then going into severe bear markets. And it appears that we are going into another bear market in the dollar. This is typically positive for gold and commodities, and it has been in the past at least. So it kind of goes back to our poker analogy again, guys. I'm a big student of game theory and poker. I like poker. And basically in a poker game, you are, especially in Hold'em, you are looking for certain cards to get in certain areas of the table where you're sitting in place position that give you certain odds that you can calculate in your head, will typically give you an advantage or disadvantage. And this is kind of the same thing. We're being dealt a set of cards here, or a set of circumstances, if you will, events such as this, such as the interest rate cycle, that if we look in the past, just like if past poker hands, we know that if we play them a certain way, we know that in a certain amount of percentage of times that they will play out a certain way. And that's what I'm trying to get at here. I hope I explained that good enough, but we're looking at a historical narrative here of things that have happened in the past and are now lining up as they have in the past. And we are looking then at the outcomes that happened in the past based on a set of circumstances. We see the same set of circumstances lining up currently, and we're saying, okay, what's the percentage chance that the outcome is the same as in the past? So these data points are pointing to times in the past, such as when we're in Fed interest rate raising cycles that eventually leads to a recession, a reckoning in debt and stock markets, drawdowns that can be 30, 40, 50%. And so that's what we're looking at. And I'm not saying it's going to happen tomorrow or next week, but I would do say that if they continue to raise rates like they're doing, and not only are they raising rates, guys, we need to remember there's a quantitative tightening happening in the background that not many people are talking about. And what I mean by that is that the Federal Reserve has reversed its policy of buying debt, buying the government's debt. They're now actually selling it and not rolling over the maturing debt that they're getting at a rate of $50 billion a month. So this is in addition to the interest rate increases that are going on. So you have this basically liquidity tightening on steroids that has never been attempted before. So we don't know what's going to happen, but we do know that if we surmise or suppose that the preceding everything bubble was enabled by central bank money printing and buying of bonds and quantitative easing, then if we're reversing all of those, it stands to reason that the everything bubble is going to deflate. That is the gist. I thought this little cartoon was kind of indicative of one of the things that they said in Gold We Trust report. Basically, their view is that, and I agree, one of the main stumbling blocks for a gold bull market is the current stock market ongoing bull market. So there's an opportunity cost. There's only so much money in the world, investment money. Right now it's seeking return in the stock market, and the stock market continues to go up. As a matter of fact, I think we will have a final blow-off top in the stock market. I don't think we've seen the highs. I think we will see one final rally to suck in every dumb dollar out there, and then that will eventually be scuttled by the continued monetary tightening that we see. But I think this is an interesting cartoon. It's kind of funny. The three wise men who are going to visit the newborn Christ, and the guy says, gold? No, I decided to bring equities. So he's talking about, I guess he's bringing Jesus some stock certificates. Here's another chart out of the report. You've seen this before. I've put it up before, and various other people have shown it in the traders and investors. But as a ratio, stocks are expensive relative to commodities, or you could say commodities are cheap relative to stocks. And you can see the median there, 4.15 or 16, and you can see where we're currently at. Even if we have mean reversion, we are going to see a tremendous rally in commodities, in my view. Or the other outcome could be commodities stay where they're at, and we have a massive decrease in the stock market. Or what is more likely, we will have a rising commodity market with a lower stock market, and we will meet at some median. However, as you can see from previous iterations, typically when you get below the mean, you always seem to revert and go above the mean. So I think it's a tremendous opportunity. We've talked about it before. I'm a bull on commodities. I'm a bull on gold. But we're talking mid to long term. We're talking, guys, 3 to 5 years out. So this is another chart that they had in there, and I think this is really what people need to focus on if they're going to talk about gold. A lot of people will talk about what drives the price of gold, and I've convinced myself, based on my research, that the driver of gold is real interest rates. It's not inflation. It's not wars in the Middle East, although these things can have some effects in the short term. The true driver of the price of gold is real rates. And when I say real rates, I'm talking about if you want to use the 10-year Treasury rate minus the inflation rate, that gets you the real rate of what real interest rates are. So if you have a 2% 10-year Treasury rate and your inflation rate is 3%, you have a negative 1% real interest rates. And the reason why gold performs in a negative interest rate environment is because if you have an inflation rate that's higher than the current risk-free Treasury rate, then you are losing purchasing power. If you have an inflation rate of 5% and you're only getting 3% on your bonds, you are losing 2% a year. And that, because gold pays no dividends or interest, when we have a negative interest rate environment, gold then becomes a outperformer. Holding it, there's no opportunity cost to holding gold in a negative interest rate environment, and that's typically an environment with higher inflation or some economic dislocations that are going on. So I think if you keep an eye on the real rates, that will give you an indication of when gold will be in a bull market. And you can see as real rates get down to like -3 to -4%, that's when gold really spikes. So that's really the thing to watch in my view. That's the true driver of gold, is the real interest rates, and that can be easily calculated using information on the Federal Reserve St. Louis Fred site. So as we said before, here's another chart from the report. But as I said before, here's a chart that shows interest rate raising cycles going back to like 1914 and the number of recessions that they have preceded. So you have this, it goes without saying, guys, if you're going to drain liquidity from the markets, liquidity is what drives the economy, what drives these markets. If the Federal Reserve is raising rates and draining liquidity from the markets, it goes without saying, it's not disputed, it's not for argument, it's just at what level of rates and tightening does the recession get initiated. So we are in another rate raising cycle. It's my intention, I'm maintaining that the Federal Chairman Powell will continue to raise rates until something breaks. I mean, this is Soviet-style central planning at its best, thinking that you can control a dynamic $21 trillion economy by raising and lowering short-term interest rates. It's akin to walking around with a 10-pound maul and trying to, solve every problem. Everything looks like a nail. So you're just hammering away with this blunt instrument that, so now we're, no one would think it was rational or normal or productive for the bureaucrats in the government to set the prices of canned peaches in syrup. People would think that's ridiculous. They would be talking about socialism and communism, but no one blinks an eye about the masters of the universe, the so-called PhDs, who have never got it right once, determining what the proper rate of interest rates are in a dynamic economy like the United States economy. It's totally ridiculous. It's going to happen. We're going to have a recession. I don't know when it's going to be, but it is going to happen. The problem is that we have such levels of indebtedness. We have such distortions in the economy because nothing has been allowed to get repaired. You can see in this chart. Notice how every time we have an ensuing rate raising cycle, it only gets, the economy is wrecked or put on the rocks at even lower and lower levels of rates. So what happens if we get to 2.5%, 3% on the Fed funds rate, and that initiates a huge recession or financial calamity? What are they going to do? What tools are in the toolbox? Lower rates to zero, negative interest rates, additional bouts of QE. I think that's a positive environment for gold, guys. And I think right now with gold being off the radar, no one's talking about it, no one's buying it, no one cares about it. It's still at $1,300 an ounce, basically. I think this is the opportune time to be buying gold and to be looking at quality gold equity shares that will perform in a rising gold environment. So that's the quick and dirty. I mean, like I said, it's a 268-page report. I'm going to put the links in the show notes, as I said earlier. I encourage you to read through it, guys. I don't agree with everything that's in there, of course, but I think we need to be taking a look at gold. I've made a recent video about it, of why you need to own gold as portfolio insurance and insurance for your financial well-being. It goes back to I just love the Ray Dalio quote when he says that if you don't own gold, you don't understand history or economics. And I think that's what I've tried to do, is just give you a brief introduction to the history here and the understanding of the fact that these interest rate cycles in the economy that are initiated by these bureaucrats will lead to a recession. And what happens as we are severely over indebted, the economy has tremendous distortions in it that have to be cleaned out. And what's it going to look like the next time down? And I just think that in that type of environment, gold's really going to perform well. So I know for some, gold's boring. I mean, everybody likes to hear the uranium videos, and I don't get a lot of responses on these gold videos, but I'm still going to keep putting them out, guys, because I'm not a gold bug, if you will, but I see the opportunity. And I hope I've presented this information in a manner that you see it also. So that's it for this week, guys. I hope the volume's better. Let me know. I've tried to change a few things on the video to try to improve the volume. I know a lot of guys were complaining that the volume was too low. Hopefully I've been able to fix it, but let me know. Please subscribe, guys. That's the best way you can help me. As you subscribe, it raises my social capital. It gets other people to watch the videos because they think that we know what we're talking about. I really do appreciate the comments. I try to respond to a lot of them. One of the things I'm really not going to be able to respond to, guys, is when people say, well, what do you think about so-and-so company versus so-and-so company? These videos are for general information, and I really have to reserve my views on certain companies to the subscribers of the Actionable Intelligence Alert. They're paying for my recommendations and my research. So I really won't be able to respond to what do I think about XYZ company versus ABC company. Some of those companies may be covered or not covered in the Actionable Intelligence Alert, and it certainly wouldn't be fair to the guys that are subscribers. So having said that, I encourage you to take a subscription. It's no risk, money back guarantee, $79 per year. You get one issue a month. Typically, I put out a new pick per month. Sometimes I don't if there's nothing that looks good. And you have access to our previous issues. So consider taking a subscription to the Actionable Intelligence Alert. So that's it for this week, guys. I thank you for listening. Thank you for subscribing, and we'll talk to you next week.